In the world of finance and business, two terms that are often used interchangeably but have different meanings are turnover and revenue. While both are crucial indicators of a company's financial health, understanding the difference between them is vital for business owners, investors, and anyone involved in economic analysis. In this video, I will clarify the concepts of turnover and revenue, their differences, and their significance in business operations. Let's discuss them separately. What is turnover? Turnover, in its broadest sense, refers to the frequency with which a company sells and replaces its inventory over a given period. In different contexts, turnover can also mean the rate at which employees leave a company or the number of times an asset is replaced or used up within a specific period. However, in the context of sales and finance, turnover most commonly refers to the total amount of sales or income generated by a business from selling its products or services over a period of time. Types of turnover. Number 1. Inventory turnover. This is the number of times inventory is sold and replaced over a period. High inventory turnover indicates efficient sales and inventory management, while low turnover may suggest overstocking or weak sales. 2. Employee turnover. This refers to the rate at which employees leave a company and are replaced by new hires. High employee turnover can be costly and disruptive, whereas low turnover often indicates a stable workforce. 3. Asset turnover. This measures how efficiently a company uses its assets to generate sales revenue. It is calculated by dividing sales revenue by total assets. Now come to what is revenue. Revenue, also known as sales or turnover in some regions, is the total income generated by a company from its business activities, typically from the sale of goods and services before any costs or expenses are deducted. It is often referred to as the top line because it appears at the top of an income statement. Key aspects of revenue. 1. Gross revenue. The total income generated from sales before any deductions such as returns, allowances, or discounts. 2. Net revenue. The amount of revenue remaining after subtracting returns, allowances, and discounts. It provides a more accurate picture of the actual income generated by sales. 3. Operating revenue. Revenue earned from the core business activities, excluding income from other sources like investments or one-time sales. 4. Non-operating revenue. Income derived from non-core business activities, such as interest on investments or the sale of assets. Now come to turnover versus revenue. Key differences. Number 1. Importance and effect on business. Both turnover and revenue are vital for companies and organizations because they measure and indicate performance for the financial year. Turnover rate allows businesses to determine their efficiency in managing company resources, which comes in handy when planning and controlling production levels. Revenue is critical for a company because it helps management understand the strength of the business, its size, the customer base, and its market share. In addition, increased revenues indicate stability, showcase business confidence, and make it easier to raise capital on credit or get loans. 2. Formulas for calculating turnover and revenue. Businesses must calculate their turnover ratios and revenue during every financial year to ascertain their financial health. How to calculate turnover rate. Cash turnover equals net sales divided by cash. Fixed asset turnover equals fixed assets divided by net fixed assets. And total asset turnover equals net sales divided by average total sales. How to calculate total revenue. Total revenue equals total sales minus returns. Number 3. Financial reporting. Turnover may not always be directly reported in financial statements but is derived from other figures, like the cost of goods sold or COGS and inventory levels. Revenue, directly reported on the income statement and is a critical metric for assessing a company's financial health. 4. Effect. Turnover affects the efficiency of the company. On the other hand, revenue affects the profitability of the company. Why understanding the difference is important. Understanding the difference between turnover and revenue is crucial for making informed business decisions. While revenue directly impacts a company's profitability, turnover provides insights into the efficiency of operations. For instance, a company might have high revenue but low turnover, indicating potential issues with inventory management or asset utilization. Conversely, a company with high turnover but low revenue may need to focus on increasing its sales volume or pricing strategy. For investors, analyzing both turnover and revenue provides a more comprehensive view of a company's operational efficiency and financial performance. Businesses, on the other hand, can use these metrics to optimize their operations, improve profitability, and enhance overall performance. Let's move on to the conclusion. While turnover and revenue are related, they serve different purposes in the analysis of a company's financial health. Turnover helps in assessing the efficiency of a company's operations, while revenue measures the success of its sales efforts. A clear understanding of both metrics is essential for making informed decisions that contribute to the long-term success of a business. If you want to read it or download the PDF, go through the link in the description. Like the video and don't forget to subscribe to Education Leaves.